Let's look at the two absolute extremes of equity investing. On one end, a company collapses and wipes out every dollar of shareholder capital. On the other, a company's value compounds geometrically, multiplying the initial investment 10, 20, or 50 times over. These extreme market outcomes are rarely the result of market noise or pure luck. They are the deterministic outputs of a company's underlying capital structure. At the negative limit, we find structural insolvency. This is the point where a business physically runs out of cash to service its debt, triggering a forced liquidation. At the positive limit, we have the multibagger, a highly tuned compounding engine that generates immense cash and reinvests it at massive rates of return. The core challenge for professional analysts is quantitatively distinguishing between a company headed for liquidation and one preparing for exponential growth, long before the broader market recognizes either trajectory. To do this, we use two distinct mathematical frameworks. The first relies on multiple discriminant analysis or MDA to algorithmically predict corporate failure. The second utilizes a four-factor compounding matrix designed to identify massive upside potential. While they measure opposite outcomes, both frameworks pull from the exact same bedrock of corporate accounting: assets, liabilities, and net income. When you intersect these two models, you map the entire landscape of corporate health. Mastering equity valuation requires the simultaneous application of downside predictive algorithms and upside compounding formulas to accurately weigh both the risk of ruin and the mathematics of extreme returns. True financial distress occurs when a business loses the structural ability to meet its financial obligations as they fall due. Evaluating a company by looking at a single accounting ratio, like profit margin or a current ratio, often fails to reveal deep compounding balance sheet rot. A company can show strong top-line sales while quietly suffocating under hidden liabilities. In 1968, Edward Altman developed a breakthrough method for predicting corporate bankruptcy that solved this problem. Multiple discriminant analysis collapses hundreds of complex balance sheet variables down to a single metric of total risk. Altman's Z-score formula isolates 5 specific ratios. By applying precise weights, a score below 1.8 indicates severe financial distress. Conversely, a score over 2.99 mathematically verifies a secure balance sheet. Modern derivative models, such as the Grover G-score, or as Majewski X-score, adjust these exact variable weights or add new ratios, but they all utilize the exact same underlying mechanism. These algorithms flag balance sheet deterioration well before a company actually misses a debt payment or issues a profit warning. Multiple discriminant analysis proves that corporate failure leaves a statistical footprint, visible in the accounting data up to 3 reporting periods before the broader market ever reacts. A high Z-score guarantees basic survival, but it does not generate exponential returns. We have to pivot to the upside and ask what metrics actually drive geometric growth. This table tracks Usha Martin and Jane Irrigation. Notice the strong sales growth in the top rows. Top-line revenue is a false positive if it fails to generate operating cash. Look below. Massive explosions and leverage were required to mask poor capital efficiency. Aggressive revenue growth funded primarily by debt is not a multibagger signal. It is simply a delayed trigger for a collapsing Z-score. Before applying upside mathematics, there is one qualitative factor that completely supersedes all algorithmic models: corporate governance. Every financial model inherently assumes the baseline integrity of the reported accounting data. If the numbers are fabricated, the mathematical output is useless. B. Ramlinga Raju, the founder of Sodium Computer Services, serves as a textbook case study in data failure. The company's promoters engineered complex financial transactions for personal gain, heavily diluting and destroying equity at the expense of public investors. This highlights the specific danger of detrimental related party transactions. Deals struck between group companies that siphon capital out of the main entity, a pattern often seen in promoter-heavy or family-owned structures. More recently, the financial institution DHFL maintained a peak market capitalization of 21,000 crore rupees, all while hiding an 82,000 crore debt load entirely off the books. Hidden liabilities bypass standard ratio analysis completely. The Z-score cannot warn you about debt that the company illegally conceals. Strong governance frameworks are built on absolute transparency and capital allocation strategies that prioritize shareholder equity above promoter enrichment. Corporate governance acts as a strict zero in the compounding equation. It is capable of instantly vaporizing equity, regardless of a high reported return on equity or a perfect balance sheet. Mathematically verified, we can apply the true compounding formula required to identify a multibagger stock. This matrix requires 4 strict inputs: sustained profit after tax growth, absolute capital efficiency, strong cash flows, and verified governance. This differentiating return on equity from return on capital employed is crucial. Consider a high-margin factory weighed against a low-margin retail operation. The retailer's extremely low capital intensity allows it to turn over capital faster, mathematically generating a vastly superior return on capital employed. This chart displays Eiffel Motors and Britannia Industries. True wealth creation requires continuously reinvesting profits above the cost of capital. Green boxes show massive compound annual growth in net earnings. Below, high return on equity percentages prove this growth came through high-efficiency capital reinvestment. The ultimate market mechanism that translates these internal accounting metrics into exponential stock returns is price to earnings, or PE, rewriting. To measure the attractiveness of a company's valuation, analysts use the PEG ratio, calculated by dividing the stock's price to earnings multiple by its actual earnings growth rate. The math here is absolute. A company compounding its earnings at 25% annually will double its baseline profits every 3 years. Compare that aggressive 3-year doubling timeline against a standard risk-free market instrument, which might take 12 long years to double your initial capital. This massive divergence in performance forces institutional capital to aggressively flood into the high-growth stock. Look back at the average PE ratio rows. As institutional money chases compounding growth, the market pays a premium, driving the valuation multiple upward. The final rows show compounding earnings colliding with a higher PE multiple, yielding massive 44x and 12x returns. These returns are not market anomalies. They are systematic mathematical outputs. Geometric equity returns are the strict logical result of high capital efficiency colliding with an expanding valuation multiple. We can now map a unified theory of fundamental equity valuation across a complete spectrum of corporate health. The downside is anchored by a Z-score below 1.8, negative operating cash flow, and heavy structural debt reliance. The upside is governed by a sustained profit after tax growth rate above 15%, a return on equity far above the cost of capital, and strictly positive free cash flow. An analyst must deploy both sides of this spectrum simultaneously. Focusing only on growth invites value traps and false positives, while focusing only on safety leaves massive returns on the table. This dual approach embodies the core philosophy of long-term business economics and management capital allocation. While the stock market can act as an erratic voting machine in the short term, driven by sentiment and momentum, it always reverts to fundamental math over the long term. The markets function strictly as a weighing machine. Ultimately, long-term corporate value is derived entirely from two factors: algorithmic statistical safety and capital cost.